Welcome to This Week in Money. I'm Jim Goddard. Today, Ross Clark from chartsandmarkets.com runs down the major markets. The Dow and S&P 500 hit new highs, and certain sectors have started to show new life. Ross also looks at gold. Publisher of the Campbell Real Estate Timing Letter, Robert Campbell, checks in from San Diego to discuss U.S. and California real estate. He says the Golden State is booming, except for San Francisco, where office vacancies have hit 30%. WolfStreet.com's Wolf Richter weighs in on consumer debt, the skyrocketing price of used vehicles, the push for electric vehicles, and gold. Plus, at the end of the show, we'll have a company showcase update with American Manganese President Larry Reaugh. We'll talk to Ross Clark right after this.
Engineer Gold Mines is focused on the exploration and development of the historic high-grade Engineer Gold Mine situated 32 kilometers southwest of Atlin, British Columbia. Engineer Gold Mines is fully permitted for surface and underground exploration with the drill program now underway. Engineer Gold Mines Limited trades on the TSX Venture Exchange, symbol EAU. For more information, please visit us at engineergoldmines.com.
Welcome to This Week in Money, the source for market opinions. Here is Jim Goddard.
My guest is Ross Clark from chartsandmarkets.com, where you'll find insightful market commentary and timely technical analysis. You can find him on Twitter at ChartsByRoss. Welcome back to the show, Ross.
Good to be back with you, Jim.
Ross, the Dow and S&P 500 again hit record highs over the week. What's the story there?
It's a broken record, and the Fed just keeps putting money out there. And I guess at some point, if the taper were to kick in, then momentum might start to come out of this market. But just inching its way up. But, when you take a look at it, I think of what I say 2 weeks ago, it was 50% of the stocks on the S&P were above their 50-day average. Last week, it was into the high 50s, and as of this week, I think you've got 62 to 63% of the stocks. So there's a little bit more buoyancy coming in, but overall, the percentage of the stocks that are making new highs is continuing to stay small. This is becoming a more and more selective rally for the really strong ones, and the big cap names are really the ones that have been driving it. When we take a look at the S&P index and the breakdown there based upon capitalization, the index, if you look at the average capitalization, you just take about every stock in the S&P and give it equal weighting. That actually topped out 2 months ago. But it's been the big names that have continued to push it along, and here's a Disney at the end of this week, another good move that pushes an index like the Dow into new highs. So when we take a look at it, the leadership there for a while, big leadership was over in the Nasdaq. That one is starting to wane. You've got a number of these Hindenburg omens starting to kick in. That's where you get 2.5% of the stocks making new 52-week lows. At the same time, you got 2.5% or more making 52-week highs. So it shows that diversification that's happening in the market. And so we do see that in the over as far as the Nasdaq is concerned. And we've seen that historically when the market started to go into choppy phases. And then once you start to see that kick in with the NYSE, where you get that same 2.5% move, that becomes a big warning sign. Now, we don't have that at this point. Just looking at Friday on a closing basis, I think you had 300 stocks in New York making new highs and only 30 making new lows. So from that perspective, there's probably some more time left in it. We've never had a major crash in the market without a Hindenburg, but not all Hindenburgs turn out in major crashes. So I'm still of the mindset that when the correction comes, it'll probably be in that 10 to 11% range, and I think that's the reasonable thing to be looking at for now.
You mentioned subsectors are lighting up again after being just totally dull.
Yeah, I mean, take a look at it. You had things like the financials here. They topped out in the last week of May, had a pretty decent correction. The XLF index topped out around 38 3/4, backed off to 35. So that was a nice, what we got, just shy of 10% correction. It's back at new highs again. You take a look at the metals and materials, the XLB, same type of thing. Peaked out around 89, dropped to 79, nice big correction. That's back at 86 at this point. So there is rotation going on the other side of the coin. You got the semiconductors, which had peaked out now about 10 days ago. They're backing off and not having the same kind of momentum. So markets, are a sum of many items, and some of these things are showing life. I mean, gosh, look at what's happening to Pfizer and Moderna. Huge runs there, and clearly that is news-oriented. But both of those, and I always like to look at stories that have made it to page one and headline on page one. Both of those now have put in what I consider to be pretty excessive price levels on this run, and they're set up to the point where loss of momentum, which we're actually seeing in Moderna and maybe starting next week in Pfizer, can get a pretty good correction, probably back towards their 20-week moving averages.
What's going on with gold?
Well, that's, you take a few days off for either holiday or family matters and things go crazy. So this week, that's Sunday night, they had that massive sell-off in the gold market down into the mid-1700s. And by the time we got to the end of the week, things were coming back. We got signals on Thursday's close on the gold, silver, and on the miners, the XAU, the QE, the GDX indices, that you tend to see at interim lows. So that signal typically, when it kicks in, and say that was on Thursday, you'll get a 5 to 8 day run right off the bat. So as of Friday, gold market up nicely, $28. Silver market up anywhere from 60 to 70 cents on the day, and we get about a 2% move on the miners. So not a bad turn off that big break. I see that the commitment of traders numbers starting to look a little better here. The break on, because it happened early in the week, and the numbers are compiled as of Tuesday's close. We see that there was a reduction of 28,000 contracts from the net long position of the speculators, and a reduction in the short position of the commercials, say by 28,000. And that was a pretty good percentage. 28,000 takes us down to 168,000 on the commitment of traders for the gold market. If there was another bit of a clean-out like this in the coming weeks, that would put the COT levels for us into a whole new buy signal. And we had one of those a number of months ago at the last really good low. And if there's a subsequent break after this bounce, could end up with a pretty good longer-term buy signal.
Ross, what's going on with the U.S. dollar?
Great rally last week, and then on Friday it gave up the ghost. So I think 93 on the index in the last couple of days, then down to 94 and change. There's a lot of good resistance up here, and the overall appearance of it still, I think, is a basing pattern that we've been going on through since the latter part of last year. And it's basically it's a trading range, and at the top end of the range, as we were a week and a half ago, becomes a little bit vulnerable. But I think you take a look at the intermediate trend being to the upside, unless proven otherwise. So with the index is stuck at, say, let's call it 91 80 to 93 and a quarter, and we're dead center on that one as of the end of the week. And I wouldn't be looking for a big breakout on that one in the near term.
Ross, thank you so much for chatting with us.
Good to be with you, Jim.
My guest has been Ross Clark from chartsandmarkets.com, where you'll find insightful market commentary and timely technical analysis. You can find Ross on Twitter at ChartsByRoss. Coming up, Robert Campbell next on This Week in Money.
Always consult your investment professional before making any investment decision.
Media recognition from Bloomberg, Reuters, recycling trade publications, patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back. My guest is Robert Campbell, author of Timing the Real Estate Market and the Campbell Real Estate Timing Letter. He's speaking to us from San Diego. You can find him online at realestatetiming.com. Bob, welcome back to This Week in Money.
Hey, thank you very much for having me again. I always enjoy this talk.
When's the next Campbell Real Estate Timing Letter coming out?
The next one's coming out September 15th. I publish it 6 times a year, once every 2 months, and you can learn about it at realestatetiming.com. This is my 19th straight year of publication, so I was one of those guys that after 15 years I became an instant success.
You're getting back to doing live events. Where, when, and will you let unvaccinated people in?
Oh, yeah. Oh, thank goodness. Yes, at least, according to 2 months ago, the La Jolla Marriott here in San Diego called me and he said, we're doing live events now. And I said, are you up for doing some more seminars? And I said, absolutely. I said, I only have 2 requirements. I said, 1, no masks. 2, no vaccinations required. And she said, after June 1st, Mr. Campbell, it's a go. And I said, let's set the date. So we set a date of October 23rd, and so we're all good to go with the way things are going right now. However, you never know. I mean, now we got 2 new viruses that are raging according to the CDC. So we're going to be talking about that today. So anyway, so far so good. It's all set for October 23rd, and I can hardly wait to see people face to face. That's the only way I will do any engagement other than a show with you guys, Jim, on House Street. All my other, personal Zoom meetings with real estate clubs in California and around the country, I've declined. I've just said no, thank you. I'm a live in person, kind of guy. I like to look you in the eye and see what your reaction is, and walk around like a saber-toothed tiger and just really enjoy myself while I'm in front of a live audience. That you can have this Zoom crap.
Could the COVID push be coming to an end, and what could it mean for the economy?
I think so. I think we are getting to the point where this thing is all going to stop. These forced vaccinations are stopped. Here in the United States, they say that about 20% of all Americans are unvaccinated, and I would say a high percentage of those unvaccinated people have drawn the line. They're standing up for the rights, and they're not going to be vaccinated. One way or another, they're not going to be vaccinated. And also yesterday, I was really encouraged that, that my theory is correct, because I think it was Southwest Airlines, Delta, and one other major airlines said, we are not requiring the people that are our employees to be vaccinated. They said, we encourage it, but we're not requiring it. 3 major U.S. airlines. So what are the CDC and the government going to do about that? They're going to shut them down? I don't think so. So I think we're getting real close to that turning point where that everybody has heard enough and seen enough and drawn enough conclusions to say, no more vaccines. There's there's as much danger to this as potential good. And I think we're coming close to that point. I'd say in the next 30 to 60 days.
On the other hand, if the variants continue to be pushed and possibly even climate change lockdowns, what could happen to the economy?
Well, if that's what they push, and they come down with these mandates, and there's enough people that are still going to honor them, that could shut down the economy again, where all of a sudden, production goes down, unemployment goes up, the government's going to have no choice but to keep printing money, to keep businesses out of bankruptcy court, to keep individuals, from being homeless and eating out of garbage cans. So once again, what are the consequences of that potentially? That higher inflation. You'd have decreased production and increase in the money supply. Too much money chasing a scarcity of goods. That results in higher prices. So this could go on deeper than you think. And the government's not going to let's say the government went in and let's just say, for example, and shut down those three major airlines. You think they're going to let them go broke, or you think they're going to print money to give them so they don't go broke until the quote-unquote new flu scare is over? Of course they're going to print money.
Could inflation happen in select assets and not in others?
Oh, well, of course it could. Where it happens the most typically is in the essentials of life, like housing, energy, food, and medical. Because there's no, you can't do without them. You don't need to go out and buy a new car every year. You don't need to buy even though TVs go down in value, go up, which is, and not up, which of course is why the government likes to quote the price of TVs, as much as they can, to try to convince you there's no inflation. But sure, it's those essentials.
Fear versus greed. Your thoughts?
Well, that's what makes the world go round. That's what's always made the world go round. And right now, as far as the vaccinations, it's being driven by fear. But I think that has finally come to an end. It's slowly coming to an end. The greed part is in the asset prices, like housing. Housing is appreciating at the fastest rate right now in recorded history here in the United States. Faster than ever. And so the stock market's at or near record highs. The bond market is at or near record highs. The only thing that that these asset prices, of course, higher asset prices don't generate any income unless you sell them. I don't care if your house is worth 1.5 million this year, and it was only worth 1.2 million last year. That doesn't generate any income for you unless you borrow against it. Now you start borrowing against your house so you can live. That's what's so bad about inflation, is that it lowers everybody's standard of living. Everybody. You can't keep up with inflation. You're going to lose. So, let's say inflation right now is going off at 6 to 8% in a realistic manner, even though the government says it's only 6. It's way understated because the price of housing is not included in that index. And the price of housing, even though they say it's not a consumer item, most people move from one house to another house every 7 to 10 years in the United States. But they do include the price of new cars in the CPI index, because they say that is a consumer index. They say that is a consumer item. Guess how long that the average car on the road is? People are keeping their average cars nowadays in the United States. 13 to 14 years. In other words, you keep your car longer than you keep your house, but they want to include cars in the CPI and not the house. Now, that doesn't make any sense at all.
Does freedom have a price?
Absolutely. Sure does have a price. And that's what it's coming to right now. Most people, it's give me liberty or give me death. That's the United States, and that's where that hardcore 20% of the unvaccinated, are in America right now. They're not going to back down. So they're not going to back down. I just really believe that. And most people, I think it was Thomas Jefferson. He said, I think something like this, paraphrasing, I prefer dangerous freedom to peaceful slavery. And there's a hardcore 20% that are saying, I'm not doing it. I'm not doing it. I'll stand up. You're not going to force me to do anything against my own will. That's against my civil rights. That's against the Constitution. And it's against everything that I believe in. So the answer is no. And you know what? If a large segment of the population, which 20% are, that's an unstoppable force, Jim.
President Biden, the first thing he did was cancel the XL pipeline from Alberta down to all the refineries in Texas and Louisiana. Now he's asking foreign countries, not Canada, to supply more oil to the U.S. because he's getting kickback from high gasoline prices. Just how illogical is that? Isn't Canada your most reliable source of oil?
Yep, it's totally illogical. Biden's first moves in office were just undo everything President Trump did. That's what he did. It didn't matter what it was, and that was one of those things. So now we're paying the price for that too. Just one more misguided policy coming out of the government.
California has a governor recall race in September. Could this end up being a good thing for California?
Oh, sure. September 14th, they have a recall election, and with a recall in the existing governor, Newsom, and it looks like a guy named Larry Elder. There's something like 80 people competing for the job that would like to be governor. The lead horse is a guy named Larry Elder. He's a black guy. I don't know what his profession is, but he's been on the TV show a lot, and he seems like a pretty good guy, straightforward guy. You know, he believes in free markets, smaller government, you know, freedom of speech, and all those old-fashioned kind of things.
In California, what's happening with renter rights?
Oh, that is a real hot spot. Everybody listening in here in California, that it used to be that if you owned property, you're the one with the rights. You own it. Now in California, it's the person that occupies the property that has the rights. I just heard a story from I've had one of my friends tell me the other day. He was up in the Bay Area, and somebody came to him and wanted to rent Section 8, which is subsidized housing, and you get a lower quality tenant, and you know they can't pay the bill, and the government's going to pay it. And so, aside from that, that's a whole different kind of person that he has in his apartment project. And he said, "No, I don't rent Section 8." That person took him to the government, and the government fined him $6,500 for not renting to the guy. There's other cases in San Francisco. There's a retired couple living in San Francisco. They're renting a 2-bedroom apartment overlooking Golden Gate Bridge, which is a magnificent view if you've never been there. And the owner of the property wanted him out so he could redevelop the property. It was obviously a very expensive property. He had to pay them $475,000 to get him out. There are attorneys representing tenants all over California, especially up in the Bay Area. That's the most liberal of all, that because tenants have all the rights. I can't verify this, but I get it from knowledgeable sources. They say the average payoff to get somebody to leave an apartment or a rental house right now in California is between $25,000 and $50,000. So to me, what this means, to be a small landlord in California, and most landlords are small. They own, but 70% of all landlords in the United States own either 1 or 2 units. Owning rental property in California is pure insanity. Who would put up with it? You can't control your destiny anymore. The government's going to tell you what to do. I just get out of the market. And I'm a real estate guy. I mean, you know, I've made, the majority of my money in real estate. But you have to acknowledge the risks versus the potential rewards and say, wow, that's a huge risk. In addition to that, Biden wants to raise the capital gains taxes on all assets from a current high of 37% to 57%. Why? To pay for all these government programs that he's got planned out. Why would you own a piece of real estate and take the risks that are there? And there are risks that are there. That's not a guaranteed profit.
With an attitude like that, do you see California running out of rental properties soon?
Yeah, you could, because nobody's going to rent. You're going to find renters other than big landlords. I don't know where it would be, where people say, no, I'm not going to rent a piece. Why would I put a renter in a piece of property, if it could be, a living hell getting him out? Nobody would do that.
What's happening in the California real estate market?
California real estate is appreciating faster than almost any place in the United States. With the exclusion of Idaho and Montana. In other words, people are getting out of Dodge, but like You look at Los Angeles. Los Angeles is the fastest, has the highest appreciation year over year in the United States, followed closely by San Diego. The Bay Area is lagging, interestingly. They got problems up there. They got problems up there like a 30% vacancy rate in commercial property, because nobody downtown has been, it's like a ghost town. So they got lots of problems. San Francisco's got more problems than anybody.
Is there still foreign buying happening in California real estate?
Not nearly like it was. I can't cite the chart that I saw, but I recall reading a chart, 2 or 3 weeks ago, where the amount of foreign buying in the United States, I think it could have been California too, is way down from its peak 2 or 3 or 4 years ago. Way down. Of course, that could vary from city to city. I doubt the Chinese are buying in Missoula, Montana.
What's happening with real estate in the rest of the U.S.?
It's still smoking hot, Jim. Smoking hot. Well, you have to understand that interest rates right now, even though that they've been manipulated and repressed by the Federal Reserve Board, you have inflation realistically 6 to 8%, easy in that range, and you can borrow money 30 years from a bank at less than 3%. Who would do that? That's a guaranteed 5% loss every year. Who would do that? Only banks do it to make a transaction cost, and then because they know they can sell the loans, tomorrow at Fannie Mae or Freddie Mac, which are government owned institutions. In other words, the taxpayer will take the loss.
Gold is getting volatile following an outside month to the downside for gold in June. Have we likely seen the highs in gold for this year?
No. That's hard to say. I don't market time gold like a lot of people market time gold. I know it's highly correlated with the dollar and other things like that, other correlations. But gold, I still continue to believe gold and commodities are going to be the best performing asset classes, in the coming years. It's not going to be real estate. It's not going to be stocks. It's going to be gold. It's going to be commodities, and gold's going to outperform because that. As I've mentioned to our listeners, over the years now, they're going to revalue gold to save the dollar, to save the bond market, to save the debt. Because pretty soon we're going to get to the point nobody's going to buy U.S. debt instead of that other than the Fed, which is just exactly what's happening in Japan right now, which would result in no growth, no price appreciation, the stock market goes nowhere, the economy goes nowhere, and that presents its own problem. So in other words, to back up all this debt so that people just don't dump it, and interest rates, go from 3% to 13% in a month or two, they're going to back the dollar with like 20%, 30%, whatever gold, and that'll save the debt and save the dollar. And of course, they can't back that vast amount of dollars money supply at $1,750 gold. It's going to be more like $17,000 gold, or $37,000 gold, whatever the case may be. It's just simple math. There's so many dollars floating around that are backed by nothing, and there's only so much gold. So you have to come up with a number that says, I'll hold U.S. dollars if I know it's backed by 20% gold or 25 or something like that. But that's what I think is going to happen, and it's going to be a default mechanism. And I know that's kind of an outlier, but I've studied this, and I really believe that that's the path of least resistance when everything comes down to like either we go down with the Titanic or we revalue gold and back the dollar. That's what they'll be forced to do.
Could the U.S. dollar continue to show strength due to significant inflation that's happening in currencies across the world?
Well, it's going to show. It's showing strength. It's been stronger, over the years. It's maintained its strength, even though of our horrible monetary policy, primarily due to capital flight, Jim. People don't want to be in Europe, because there's a ton of money over there. They don't want to be in China because it's a communist country. And the money's floating into the United States, and it's just a matter that that you're still the best house on a crummy block.
Lumber prices have returned to earth. Will this be an incentive for developers to build more homes?
Well, it's certainly should be. I mean, we certainly, even though lumber's futures are down 40% from their highs, and only up like 30% from their normal range of the last 5 years or so. But nevertheless, we haven't seen those price decreases, in the lumber yards yet. 2 years ago, I paid $2 for a 8-foot construction grade 2x4. There's still $7, Jim. And so the price of a house has gone up. It's just not just lumber. It's the price of everything. There's a shortage of everything. It's hard to get, plumbing hardware, and other things. And so the availability of it has been restricted because of supply shortages. And so people are paying up for those kind of things. And the price of a house has gone up a lot. Additionally, lumber alone is $35,000. The median price, new home price. I forget what it is. I think it's between $350,000 and $400,000. But in addition to that, the price of vacant lots to build new homes on right now, they're at all-time record highs. All-time record highs. So you put all those things together. I mean, are new home prices going to go down much? I don't think so. I think they're going to stay super elevated until we have a crash, or until inflation calms down. And if they keep pressing this new flu variant, every 6 months, where we'll stay shut down forever, who knows how inflated everything's going to get? So the government's not going to let anybody go broke. Nope. We'll just print up $1 trillion here, $1 trillion there, hand it out. Right. Hand it out. So what they take from one hand, they give in one hand, they take from the other. But the inflation takes away a lot more than the government's giving.
Are people still leaving big cities in search of towns and areas that are less crowded, like the big cities used to be the big attractor decades ago?
Well, they appear to be doing that up in the San Francisco Bay Area. I don't know so much about San Diego or Los Angeles. I don't see it so much. But I mean, but it's certainly happening there for sure. I mean, that seems to be that seems to be the worst of the worst, San Francisco. Because everybody's leaving. And for example, you can go in San Francisco. You can rent a 1-bedroom apartment for like $2,500 a month. You go 88 miles east to Sacramento or Modesto or some other place in Central California. That same 1-bedroom apartment rents for $850. 100 miles away, and you can like almost cut your rent. You can cut your rent down by 2/3. That's a pretty big incentive, especially if you have the ability to work from home and you don't mind living in Central California, where right now it's probably 120 degrees.
What qualities do people need to be critical thinkers?
You need to look, just have an open mind, look at the data, analyze what the data says, and draw a conclusion based on probability theory. Nothing's 100%, nothing's 0%. It's all based on probability theory. Guys, when I write my timing letter every 2 months, it takes me about 10 days. And I just put everything aside. I don't do anything. I don't play baseball. I do go to the gym. But I stopped doing other of my fun activities. And the first 2 to 3 days, I do nothing but look at the hard data. And that's where my letter takes me. I let the data take me, let the data show me, tell me what the market's doing. A lot of people do just the opposite. I would say most people do just the opposite. They have a preconceived idea about what's going to happen to the real estate market, for example, and then selectively pick data that supports their opinion. Exactly. That is the exact opposite of critical thinking, Jim.
In theory, are there different psychological profiles for people who have dogs versus people who have cats?
Yeah, I think so. I think people that have dogs are a lot happier. I love cats, though, too. But in general, yeah. I mean, are cats going to be your best buddy? No. Is a dog going to be your best buddy? Yeah. A cat's not going to go out and hang with you at the beach. Will a dog? All day.
Although I have a friend, a singer friend of mine, her cat Angel goes everywhere she does. She walks him on a leash, and he loves to travel. So that's one cat out of 1 million. Out of 10 million. I got a neighbor that had a cat like that. Unfortunately, the cat died, and so she got another cat, and the cat won't do that.
and I swear to God, she's depressed. And I look at her and go, you think all cats are going to be like that. No, they're not.
Yeah. Like the one cat out of 100 that will play Go Fetch.
Yeah.
Yeah.
Not going to do it.
Bob, do you have any health tips for us to help us get through really these tough times?
That, for those of you that don't know me, health has always been my number one investment. And I not only talk the talk, I walk the walk. I'm really super healthy guy. The other day I was out, walking the beagles. I have beagle dogs. And one of the neighbors came up to me. He was a guy about 40 years old. He was trim and lean and in good health. And we started talking, and he looked at me, and he knows how I work out. He looked at me, and he goes, I bet you eat a lot of vegetables. And I said, yeah, I do. Why do you ask? He said, because I can see it in your skin. And he said, you're healthy. He said, healthy people eat vegetables. And I'd never thought about it before, guys. But this, because I'm looking for everything, share every health tip I can. Vegetables are fiber. The more fiber you put in your body, it goes through your body, and it's a cleansing agent, and you'll be healthier. So you have to eat vegetables. Broccoli, asparagus, salads, kale, tomatoes, you name it. The more that you eat, the healthier you're going to be. Because I know it's not cool to talk in public about going to the bathroom. But ideally, a person should go to the bathroom about 3 times a day. That's how fast that food should be going through you. It shouldn't be sitting in your stomach. Like you eat protein, and I eat a lot of protein. Is that good to sit in your stomach? No, not for that long. You eat the fiber, and that runs it through you. But isn't that interesting? He noticed that. So that's a real tip for you guys. You guys want to start getting healthier? Eat at least 1 big salad a day. My wife makes me a salad in a giant bowl. And it takes her about 45 minutes to make it every day. And I put olive oil all over the top of that, which is really, really good for you. And I eat that every day. And sometimes I even eat, broccoli and asparagus and just soaked in butter and stuff like that. But I'll tell you, it's interesting. People will notice. He noticed. He said, because you look really healthy and your skin looks really healthy. And he said, I know. He said, because he must eat vegetables too. Because I tell you, he looks healthy too. He goes, I eat a lot of vegetables. And he goes, you can tell. But I never thought about it before. So you consciously have to do that, guys. Consciously. Asparagus, broccoli, anything, you name it. Just get that stuff in your body, and it's that fiber, and it's just really good for you.
How about leaving us some words of wisdom here, Bob?
Words of wisdom. Well, that's I'm going to leave it with that words of wisdom. As people know that have listened to me over the years, I've told you, I just turned 74 years old. My dear old dad, who lived to be 91, one of his classic lines was, don't trust anybody over 50 years old because they haven't had their head in the cement mixer enough times. He was an old builder. And so, you know what? With age comes wisdom, guys. Listen to people that are older than you, that have a brain. That's why guys like Warren Buffett and some of these guys that I listen to all the time that have been through the cycles and through the wars, they have more money than they'll ever know what to do with. There's no incentive for them to try to get some new business from you by trying to persuade you into something that they know may not work. No, listen to old guys. They'll tell you. They've survived the wars. There's been ups and downs, and they're still survivors. So it's that kind of wisdom, words of wisdom. Listen to older people. They will tell you. They will tell you. My dad came through, he was a teenager during the 1930s here in the United States. Nobody had any money. Everybody lived within their means and just tried to survive. He maintained that mentality his whole life as a builder and as a developer, and he never went broke. His advice to me was, never buy anything other than real estate that you can't write a check for. And I live my life by that. If you can't write a check for it other than real estate, you can't afford it. Now, I know that's really old school, but you know what? It served a lot of us really well that have lived within our means, made a few bucks, saved them, invested them wisely. Now all of a sudden you're comfortable in life. Are you super rich? No, who cares? You're comfortable. You're doing what you want to do. You're super healthy. You love the work you do. I love being on this show. I love writing my timing letter. I love talking about real estate because I know about it. And by the way, guys, the reason what qualifies me to write the timing letter I do and opine about real estate, I was born on a building site. I like to tell people, with a skill saw in one hand and a hammer in the other.
And sawdust in your nostrils.
Exactly. And there's nothing sweeter, Jim, in my mind, than the smell of freshly cut lumber.
I know we had our own little portable sawmill on the homestead. After we hauled logs out of the forest with horses, we cut it up ourselves. That's terrific.
I mean, you know the smell I'm talking about.
Absolutely. Bob, how can people find out more about your book and your upcoming events?
They can go to my website at realestatetiming.com, just like it sounds, realestatetiming.com, and you can see the book I wrote in 2002. I've sold 31,000 copies of it from a website, and sold it on my own. I've never had to put it in a bookstore or anything. And I write the Campbell Real Estate Timing Letter. You can look at a sample letter there. And what I do is I've developed a real estate timing model that gives me a high probability of being successful and a low probability of being wrong, and that's all I can do. That's all I can give you. Nothing's perfect, but it's really accurate over any period of time, and it can help you make better real estate decisions. Because nobody can make all real estate decisions are made on an individual basis, and no two people are generally alike. Like, would retired people make different real estate decisions right now than people in their 20s? Absolutely, of course. So you just have to tailor everything to where you are in life. What's the risk of you losing a lot of money at this point in time? Could you handle it, et cetera, et cetera? But the people that are the best investors have always been the ones with the best information, Jim. It's always been the case. So you need good information, and that's what I provide.
Bob, thank you so much for being on This Week in Money.
Thank you, Jim. Look forward to talking to you again soon. Bye.
My guest has been Robert Campbell. He was speaking to us from San Diego. Now we just go a little further up the coast to San Francisco, where we'll chat with Wolf Richter right after this.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com. This Week in Money is archived online at TalkDigitalNetwork.com.
Welcome back. We're speaking with Wolf Richter, publisher of WolfStreet.com. He's speaking to us from San Francisco. Welcome back to This Week in Money.
Well, thanks for having me.
Wolf, the stock markets keep on hitting new highs. What do you see ahead for the stock markets?
I don't think I've ever seen a stock market that is so perched on the edge. The Fed is still doing quantitative easing to the tune of $120 billion a month, which is a huge amount, and some other central banks are still doing it, like the ECB. Other central banks, like the Bank of Canada and Japan, the Bank of Japan, have curtailed their QE. So, this is just I think it's a pretty crazy situation where a lot of liquidity is out there and it's looking for a place to go, and it's going into every kind of asset, and including the stock market, and it just it seems like it's going to go on forever, but it won't. These things will suddenly stop, and sometimes they just decline gradually, and sometimes that happens pretty suddenly. And lots of people are just waiting for that moment to happen. They're full in the stock market, and they are eager to they're watching this very carefully, and as soon as they see any sign that the stock market will end up major sell-off, they're wanting to get out. And so, this is not an unknown situation. Lots of people are very aware of this, and this could cause a major problem, because now you've got all this big money sitting there waiting to pull the money out. And at the same time, this may not happen for a while. So, I I don't like the stock market at this level. I think it is very, very risky.
Are consumers starting to take on more debt as the economy opens up?
Yeah, so American consumers, this is kind of interesting actually, because they use a lot of that stimulus money to pay down the credit cards. So the credit card balances plunged, and they also used the stimulus money to get caught up on their arrears. So their delinquencies plunged sharply. At the same time, car prices have soared at enormous rates, and for example, used vehicle prices are up 40% year over year. New cars are up a whole bunch. In addition to that, on the new vehicle side, automakers have really focused on the expensive vehicles, the expensive models, because they can't make enough vehicles due to the chip shortage. So they're making the expensive models and they're not making the cheaper ones. So what consumers are buying is more expensive stuff. And so auto loans, even though there have been fewer auto loans issued, they're all much bigger than they were. And so auto loan balances have ballooned, and they're now at $1.4 trillion. And yeah, and auto loan delinquencies have also dropped because people have gotten caught up on some of their arrears. But this is a function of price rather than volume. People are buying more expensive stuff, and the prices themselves have jumped. So in terms of student loans, Americans have stopped paying them back. There's a moratorium on payments, so they're all in forbearance now automatically. Nobody has to pay any student loans back, so they can take out new loans but don't have to pay back their old ones. Different generation. And so we have this crazy situation where essentially no student loans are getting paid back, but new student loans are being issued. And so student loans have, they're at $1.6 trillion, continue to grow like that. Not because people are taking out a lot more loans, but because people are not paying them back. And mortgages, of course, house prices are up nationwide by something like 24%. That requires that the home buyers are financing a lot more than they would have a year or two ago. So now mortgage balances are way higher, largely because of the higher cost of the homes on the market. And so in that respect, consumers are borrowing a lot more. In terms of the credit cards, they paid them down for a year and a half, so by a historic amount, essentially, very fast. And so now they have started charging a little bit, so there was a small uptick, but not much. I mean, consumers are still flush from all the stimulus money. A lot of consumers are protected from eviction through the eviction moratorium, so they stop paying rents. A lot of homeowners, several million of them have mortgages that are in forbearance, so they don't have to make mortgage payments. So there's a lot of money in consumers' pockets that, in part, that they haven't had to pay to satisfy the loans and rents, and in part from the stimulus payments. And there is less lending now required for consumer spending. Consumers haven't spent money on rent as much, on rents and mortgages, and they could spend that money on other stuff, and then they got the stimulus money. So, there is really the increase we see in lending is in mortgages and in autos due to higher prices, and in student loans due to non-payment of those student loans.
Is now a good time to be buying or selling new or used cars or vehicles in general?
Yeah, it's probably the single worst moment in history that I know of. Used vehicles, we just got the data today. Used vehicle prices, retail prices were up 42% year over year, and this is completely nuts. What's going on in the used car market. We've seen on the wholesale side, there is now the second month in a row we had a dip in wholesale prices, so that will eventually make its way through to retail prices. So those prices are starting to come down. But there are used cars that sell for more than the equivalent new car would sell if it were available. And people pay just extraordinary amounts of money for these used cars. And on the wholesale side, this is declining. So we see that the price drop being baked into the system now. And so when you buy a car now, a used car, it is very likely that 6 months from now there will be a substantial price drop. And not only because of the depreciation of your car, but because all of the used car universe has dropped in prices. Because after that horrendous spike, some of that spike is getting unwound. Maybe not all of it, probably not all of it, but maybe half of it. So you're looking at a significant drop in prices coming your way if you buy a used vehicle now. I can see dealers are getting stuck with these overpriced used cars that they can't sell at cost anymore, so they're going to lose some money on those. So this is really a horrible time to buy a used car. If you can drive what you have now, it is far better just hang on to it, keep driving it, and watch the market for a while. And this is just people just getting lined up to be cleaned out if they buy now. On the new vehicle side, we still are under this chip shortage, so they cannot make enough new vehicles. That is going to drag out. Again, unless you total your car and you need a new vehicle, this is a great time to not buy a vehicle, to let this craziness get out of the market, to wait half a year or a year, maybe longer, to allow for the dust to settle. I mean, this is just completely nuts what is going on in the used and the vehicle market right now.
Has this shortage or price hike really hit light-duty trucks the hardest?
Yeah, so on the wholesale side, that was clearly the case. On the retail side, to some extent as well. So pickup trucks are throughout the pandemic were the most sought after vehicle type. They're always bestsellers in the United States, but they were really now that way. And so they've also now experienced the largest price declines in the last month or two on the wholesale side. So they at one point pickup trucks were up 70% in the used vehicle market year over year. It's just completely nuts. I mean, people pay whatever to get a truck. And it just didn't even matter anymore what they paid. They just paid, and none of the pricing guides mattered anymore. I mean, it was just completely crazy what was happening there, and this impacted all vehicles, but it particularly hit pickup trucks. 70% year-over-year price increases, just unheard of. On mid-sized cars, it was more like 15 or 20%. And SUVs was higher than that. And so all of these on the wholesale side, all of these are starting to come down. And the wholesale pickup truck prices are coming down faster than the others. So I think this is going to wash out pretty quickly.
President Biden wants clean car sales to hit at least 50% by 2030. Does this create a bull market for electric vehicles and the supplies you need for batteries?
Yeah, I mean, that was actually an ingenious setup by the U.S. automakers to get EVs promoted on national TV for free. It was the three automakers that in the United States that are not Tesla, so Tesla wasn't part of that big shindig there. And automakers have already planned to put $100 billion into EVs. What is happening now is that what is growing is EV sales. And they're growing in leaps and bounds among all car makers that are making them. And there's a long list for each model to get it. There's not really any inventory. People want EVs. Our automakers are hiring engineers in large numbers to work on EVs, on software, on the battery technologies, on everything that goes into an EV and into the consumer-facing electronic system, and they're winding down or they're de-emphasizing the hiring for the cars that run on internal combustion engines. So this whole shift is being made now, and they have to build new production sites. EVs are a lot easier to build, so that will require less manual labor to put together. So there's some expectation that we're already seeing that that these vehicles will be assembled in the United States rather than in other countries, because, at least in part, because that don't require as much manual labor, and so the labor differential isn't that important. So there's a huge amount of money that is being spent in developing these vehicles and developing the battery technologies, the electronics, and building the factories to make those cars. So the boom is already happening, yeah. But it's not a boom in a vacuum. It comes at the expense of internal combustion engine vehicles, and so it's not like there is going to be an overall boom in vehicle sales. That's not the case. You know, you're having a boom on one side in EVs, and you're having a phase out essentially on the internal combustion engine side, and it will play out over many, many years. But that's the trend we're now looking at. It's not an overall sales boom in vehicles. You know, we're having a very small segment. The EV segment is still tiny. It's very small, and it's booming. And the much larger segment of internal combustion engines, that is now then has peaked actually 20 years ago. That's the thing, you know. The auto sales in the United States hit, you know, a little over 17 million vehicles in 2000. Then they plunged over the years, and in 2015 they're back at 17 million, and now we're much lower than that. So there is no growth in this business. So now the EV segment is booming, and the rest of it is starting to catch that, and that's hard to play because, you know, Ford Motor Company and General Motors, and they all make internal combustion engines, so they're going to see those decline, and they're going to have a boom in the EV segments. So it's not going to change the outlook for the company in particular. Tesla is different. Yeah, Tesla has already done all this work in the past, and they don't sell ICE vehicles, so they're in a different ball game there. And you know, they can sell so far what they can make, as can the other automakers in terms of the EV vehicles. But yet overall auto sales will not go higher. This is just a mature market, but it will shift. It will go from ICE vehicles to EVs, and it will be a boom, but it will be a boom within the current manufacturers that on the other side will take large losses. So at best, I think it will balance out.
In Vancouver, it looks like because of high government taxes on gasoline here, we're paying $6.46 a U.S. gallon for gasoline in Vancouver. Is that the goal in the U.S.? Boost your prices so high for gasoline that all of a sudden an electric car looks cheaper to run?
Well, electric cars are cheaper to run, even with current and lower gas prices. They're more expensive to buy. And that's changing now too, but they were more expensive to buy, and they are cheaper to run. So, and it depends on your electricity costs too. If you live in an environment where you have extraordinarily high electricity costs, that may be an issue. But in most places in the United States, electricity is fairly cheap compared to some other places. And so the more you drive an EV, the more miles per year you put on an EV, the cheaper it gets. And if you just buy it and it sits in your garage and it's a low mileage vehicle, you never drive it, I mean, it's nice to have maybe, but you're not going to benefit from the price advantage of operating an EV. So at this point, you know, the thing that is being talked about is actually the corollary of what you mentioned. There are all kinds of discussions going on at the state level and at the national level of putting some kind of fee on mileage and that you drive, so that EVs and ICE vehicles would essentially pay the same amount in taxes. And so that is one way, because, you know, EVs right now don't really pay a lot of highway taxes in the United States. So you built the highways, everybody drives on it, but only ICE vehicles are paying for it. So the local, at the state level, EV buyers already are having to pay higher fees when they purchase the vehicle. That's in part to pay for the highways. and I think there will be other ways to tax them. And we still have some tax benefits, some credits on EVs by some automakers. Now, GM and Tesla have already used up theirs, but some automakers still can use them. But when they run out, essentially, I expect that to just disappear, and legislators will try to figure out how to tax EVs properly, because they all need money, to fix those highways. So, and EVs are going to be there in large numbers, and they're going to get taxed in some way, and I'm sure we'll see that develop. I don't think EV buyers will escape taxation for very long.
If they want half the vehicles in the U.S. to run on electricity, where's that electricity going to come from? Because in California, due to the wildfires, they were having brownouts and asking people there who have electric cars to park them.
Yeah, that's a little bit of a red herring. Yeah, people buy an EV, they charge them up at night in the garage, so they put the charge on a timer. The timer comes on late at night, and you're topping off a vehicle you drove, you commuted 25, 30 miles an hour. And, I live in San Francisco. That's how everybody's doing it. Nobody has asked anybody to not charge a vehicle. It's the peak demand time is in the afternoon in California. You don't charge your EV then. That's when the electricity is most expensive. You charge it at night when it's cheapest. And at night, the system in California has enormous idle capacity. And the utilities, they have to pay for that. It's expensive. Idle capacity is very expensive, and there's very little demand for electricity in the middle of the night. And so that's why it's cheaper. And so what the utilities are hoping for is that they will be able to make money during this otherwise idle capacity, that they will be able to sell electricity in the middle of the night using the same equipment and the same generators and the same grid that they have. Even if it runs at capacity during the day, at night you're down. You got 70% idle capacity or more. And the utilities are really looking forward to this so that they can sell some electricity when everybody's sleeping. And that's how that's been working. Now, some people charge their EVs at charging stations, and so that will be a little different, and they'll have to choose their times. But most people charge the EVs at home at night, and that's the cheapest way to do it, and that's the easiest way to do it. You just top it off every night, and it doesn't take long to charge a vehicle for 25 miles that you used up that day, and in the morning you have a fully charged vehicle. So utilities are praying for this. This is the best thing that ever happened. In California, electricity consumption has declined for 10 years straight. We've switched to more efficient light bulbs everywhere, more efficient appliances. Industrial companies have switched to more efficient processes. Some of the heavy industry left. And so electricity consumption in California is way down from 10 years ago. And all these utilities are sitting on this declining business model, and they're having trouble finding investors interested in their bonds, because they're not having a growth business. So with EVs, hopefully, and they're hoping that this might turn around and they might actually sell more electricity over time. This hasn't happened yet. In California, 7% or 8% of the sales are now EVs, and we still haven't seen electricity sales tick up because of that. We're still below where we were 10 years ago. So, from the utility point of view, this is the best thing that could have happened, and they're really looking forward to it. It's a slow process, for these EVs to make a dent in electricity consumption. It'll be years. We just haven't seen it yet. 7%, we're still not really seeing the electricity consumption from those EVs. So, there's a lot of stuff going on around there, propagated by people who don't know what they're talking about, but, it's not in the peak afternoon hours that people charge the EVs. It's just not happening. They're doing it at night, and with the cheapest electricity, we have, the time of use charges, and so that works, and it works fine, and it has been working, and, we still don't see the increased, electricity consumption in California.
Gold is seeing volatility. What do you see ahead for gold?
Yeah, so I think a lot of people are disappointed that with the rising inflation, gold didn't jump. But when you look at the longer-term history, gold prices are not always inversely related to inflation. And over 100 years, sure. But in terms of the year-to-year inflation rates, I think it's been very disappointing for gold owners that gold hasn't gone up. But at the same time, gold has had very good 2 years before then, and has risen by a lot. And so now at these levels, I'm not too excited about gold at these prices. It's fine if you hold it, and it's fine. But I don't expect 5% or 6% inflation to make a big push in gold prices. After gold having such a run over the last 2 years, I don't think there's going to, there's necessarily any direct link between that. And so I think what the year-to-year inflation we're now looking at, so the spurt that we're now having, I don't think that will change gold prices in any way. I think gold has had a great run and is at a fairly high level, and I think it's a good place to be happy with it.
What do you see ahead for the U.S. dollar?
So the question is, which currency is the cleanest dirty shirt out there? I mean, every major currency, so the yen, the euro, the dollar, the RMB, the central banks are all in one form or another printing money. And over the past 20 years, since the euro came around, the dollar index, the DXY, is roughly flat. Right? It's had a lot of volatility, lots of ups and downs, but right now it's roughly where it was 20 years ago. And so these are the 7 currencies, the ECB, the euro, the yen, the Canadian dollar, and some others that are in that basket. And so it seems like every central bank is trying to somehow keep their currency lined up with the other currencies, and over time they're doing it. And so short term, some currencies come under pressure in that basket, but longer term, it just always somehow seems to balance out. And I don't see there any big change in that. I don't think the dollar will collapse against these currencies, and I don't think it will surge. I think there will be regular trading changes the way we've had them with exchange rates going up 10% or 15% and coming back down, that kind of thing. But overall, all countries are now struggling with inflation, and some a little more than others. But it's everywhere, and it's not just a U.S. thing, and that will be reflected in the currency. So the relationship between currencies, I think, over the next 10 years will be roughly stable, with quite a bit of volatility in between. And the Fed's going to taper, so that's pretty clear. They're going to taper the asset purchases. They will probably make the announcement in September, starting to taper the asset purchase later this year. The Bank of Canada has already started its tapering. The central banks have too. So this is a process that all central banks are now looking at, and I don't think I wouldn't count on the dollar heading a lot lower from here on out.
Is the U.S. currently in a real estate bubble?
Well, according to the data we have, we've had the biggest price increases over the last 12 months that we've ever had in the data. The data goes back to the 1980s, 1970s. And so that's no longer being disputed. Depending on what measure you're looking at, according to the Case-Shiller index, we're up close to 17% year over year across the nation. The median price, according to the National Association of Realtors, is up something like 24%. When these are huge, huge price increases at local levels, they're much higher in some areas. Nothing has gone up similarly. So salaries have not gone up like that. It is just, and that's the definition of a bubble. When an asset price goes beyond its reasonable support mechanisms, such as salaries, and it is at a level where even the Fed, which has denied the existence of bubbles forever, is starting to talk about it. At least individuals in the individual Fed governors, and they're worried about it. And from my point of view, it's the biggest bubble we've ever seen in real estate here. It's bigger than the bubble in 2005, especially in some places, in some cities. I mean, it's just extraordinary what's happening there. We have seen a decline in volume already in sales as a lot of people are refusing to buy at these prices. Investors are still buying, but individual customers starting to pull back a little bit. Bubble means that prices go up. And so everybody's kind of happy with that when that happens, except potential buyers. But when the bubble bursts, that's going to be the issue, and it may not burst all at once. Real estate rarely does that. It is more likely to deflate more or less gradually over a fairly long time, as we've seen in the past. And I don't see a lot of ways for these price increases to continue. There's already a lot of resistance there right now in the market, and we see that now every day, and it just can't go on. And that's the definition of a bubble. The mechanics to support it are just not there anymore. And I would define it as the biggest bubble in my lifetime. That's how I would just call it.
Could interest rates suddenly spike higher?
So long-term rates, short-term rates are anchored by the Fed, and the Fed's not going to do anything with them this year, and may start raising them next year, but that will be slow. So short-term interest rates aren't going to move much in the next couple of years. The long-term interest rates are held down by quantitative easing and the Fed buying bonds, especially long-term bonds, which pushes down the long-term interest rates. And so that process is now being lined up for tapering, and so the Fed's going to gradually step away from doing this. And this will give the bond market an opportunity to figure out what it's going to do without the Fed. And we've seen a surge in long-term interest rates earlier this year with the 10-year Treasury yield hitting 1.7%, and then it has dropped since then. And but it was a pretty fast increase. It doubled really in a fairly short amount of time, but it was still very low. So even if interest rates go up fairly sharply from now, they're still very low, And so if the long-term rates go to 2%, it's still very low. It could be a sharp increase, but it would still be very low. The 4%, 5% level would be something that would have a real economic impact, and I'm not sure I see that right now. The interest rates are really low, and there's a lot of liquidity out there, and even though there's a lot of inflation, there's just a lot of money looking for yield, and as soon as rates go up, more money will go into into these bonds, so which keeps rates down. And so I think there could be a spike in interest rates, like we've seen earlier this year, where the yields go up 0.5 percentage point, and then sort of stall, and then maybe drop, and then go up a little bit more. But I don't see there a significant spike in interest rates right now unless the Fed really steps away, starts raising short-term interest rates, and starts unwinding its balance sheet. And that may not happen for quite a while. So in the near term, I don't see. I can see a spike on the small scale, but this really big spike in interest rates, I don't see that.
Does the U.S. have an actual labor shortage?
That's the the labor shortage is it's just the weirdest phenomenon I've ever seen. And we have, in the United States, we have 13 million people collecting some form of unemployment insurance right now. 13 million people. That's a huge number. And we have a special federal unemployment compensation that we put in place during the pandemic, didn't even exist before. And, in addition to the state unemployment programs that are traditional. And so 13 million people are collecting some form of unemployment insurance. At the same time, we have 10 million job openings that have been unfilled, the highest ever. And we have businesses all over the place clamoring for labor. You know, they have trouble hiring competent employees. Are hiring away from each other. They're raising pay. They're raising benefits. They're trying to improve working conditions. You know, this is from restaurants on up to all kinds of companies. So there, from an employer point of view, there is a labor shortage. And they're trying to deal with it by raising prices and offering better benefits and doing these kinds of things. From the population point of view, there's no labor shortage at all. There's lots of people that could work. Some of them maybe cannot work at the moment because they have obligations to take care of the kids or their elderly parents or something. Others could work and would be willing to work under different conditions. Maybe they're worried about their health going to work if they work in an environment that's very exposed to COVID. And others just refuse to work because they are getting unemployment compensation from the state and from the federal government that exceeds what they would make as a worker, and that's been an issue. And those extra benefits, those extra federal benefits, will expire in early September for everybody. And in some states, in half of the states, they're already expiring. And in those states where they're expiring, we have seen an uptick in employment. Actually, we've seen a decline in people claiming unemployment benefits, and they're going back to work. So this is a very complex situation. You know, from an employer point of view, you have a labor shortage that's really bad, and from a population point of view, there's no labor shortage whatsoever. You know, it's just how it is. And yeah, if an employer were to offer a lot higher wages, they would have fewer problems hiring people, but that would push up the entire wage scale, and employers are doing that, but they can't be too radical about it, or they're going out of business. So they have to be able to pass on those wage increases to the consumers. And that's not, they're doing that too, as we see in our inflation numbers. But it's not an instant thing. You have to be gradual about this. And the labor shortage was instant. It just happened. Bam, it was here. And now everybody's struggling with it. And in San Francisco, restaurant pay for kitchen labor has gone from $15 to $20 an hour just essentially overnight. These are huge pay increases. And this has to be passed on to the consumer. And, so, I think we will see this labor shortage, this so-called labor shortage, gradually resolve as some of these unemployment benefits expire. We'll see it gradually resolve as the schools are reopening and kids are going back to school and parents are free to work again. There are lots of people went into retirement, early retirement, and if the situation improves, they might come back out of retirement. So over time, these people will get pulled back into the labor force. And then the labor shortage kind of phases out. But for employers right now, this is a really, really tough time to hire in every aspect. I mean, it's causing all kinds of production issues and service issues. It's everywhere, and it causes backlogs and shortages of all kinds, and it's a really messed up situation. And it's a confluence of things, including creating a huge amount of demand through the stimulus packages and through the monetary easing, at the same time constraining supply, and so it's just messed up, and it will take many more months before this gets straightened out.
Wolf, before we go, can you tell us a bit about Wolf Street?
WolfStreet.com is free. There's no paywall. All we do is business, finance, and money. And we have a vibrant commenting section, well behaved. So check us out, WolfStreet.com.
Wolf, thank you so much for being on This Week in Money.
Thank you, Jim.
My guest has been Wolf Richter, publisher of WolfStreet.com. He was speaking to us from San Francisco. And that wraps up our show for this week. We'd like to thank our guests, Ross Clark, Robert Campbell, and Wolf Richter. And thank you for listening. If you have any questions for the show or our guests, you can send them to info@howstreet.com. Now stand by for a company showcase update from American Manganese President Larry Reaugh. I'm Jim Goddard. We'll be back next week with more This Week in Money.
Comments made on This Week in Money are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at TalkDigitalNetwork.com. This Week in Money is a production of Howe Street Media Incorporated. Executive producer is Tom Allen. Welcome to Company Showcase, an advertising feature on HowStreet.com.
I'm Jim Goddard. I'm speaking with Larry Reaugh, CEO and President of American Manganese. Welcome back to the show, Larry.
Jim, it's always good to be on the show.
Larry, you had a significant news release.
Yeah, we actually got a grant for collaboration with a European company, which is the one that we have the MOU with, and which is Intervolt. And I think that's fantastic. It gave us a chance to update what's happening with Intervolt. You know, we did an MOU a few months ago with them, and I have to say that Lars Karlstrom is the president and CEO of that company, that he has a lot of insight, and he acts on his intuition, somewhat similar to myself. So he's quoted in here. He's got great things to say about the company. I'll just read that just so that everybody gets it reinforced. It's in the press release. It says, the collaboration with American Manganese is about to significantly accelerate our goals to become a fully sustainable battery manufacturer, said Lars Karlstrom, founder and CEO of Intervolt. We are very impressed with the innovation and skills the collaboration can add to Intervolt. The circular economy is no longer just a vision, it's about to become a reality. AMY will set new standards for the industry, and we at Intervolt are very proud to be part of this project. Great endorsement. And couldn't make me happier. So, we're moving ahead now. The government is involved with us. The BC, or the Canadian government, is involved with us on doing some collaboration work with Intervolt, and it kind of brightens a picture on who are we going to get the supply from, where are we going to put our plant. Not necessarily our first plant, but certainly would be a second plant. And we haven't completed the MOU yet, because you can't complete any kind of a financial structure without knowing exactly, or as close to as possible as you can, on the costs and of the operation and the cost of installation. So that will come a little bit later, but for all intents and purposes, we've got that $25 million shelf prospectus out there, and that would certainly pay for a plant. Whether it goes into Intervolt or not, I don't know. It depends on the readiness of the both of us. But it shows you that we're making progress. We're not up there with the SPACs, where you can raise, if you're a private company, you can raise hundreds of millions of dollars, if not billions of dollars, to advance your project. And if you happen to be one of the founders of Tesla, then
raising money is no problem for you. But we're just a little Vancouver company that has a great resource in our recycling process. So, if we can get $25 million to get the next advancement out, and I think that's terrific, and the shareholders would look at that as significantly reducing the risk. And I have no doubt in my mind that we are the leaders in recycling, and I've always believed that, and we've had to add different portions as the landscape changed. What we do is we want to give the Tier 1 companies and the battery manufacturers what they want, and not what we think they want. We could have probably been closer to getting a commercial plant up and running if we hadn't have bothered with the particle sizing of the end product, the cathode material. We had several months to wait to get that piece of equipment in. We had 6 or 7 weeks to get it set up. It came like in different pieces, and we had to get it wired, rewire it, and rewire it. And it's working fine now. We've put out a press release. We've shown the particle size, so we're on the right page. But what that means is that we're not jumping into something that we don't know the end result of. We want to know the end result before we enter into any kind of a financial aspect of this. If you make the wrong move, you could kill your own project. So I think there's lots of juice or lots of money involved in recycling, but we want to make sure that that we know exactly how much is involved. And our initial work told us a lot of money was involved, but then cobalt dropped off the spectrum pretty much, and nickel came in, but it's still very robust as far as back of the envelope goes. And I think the shareholders should be happy with today's press release. It answers a lot of questions. It answers what we're doing with Itovolt, and certainly we're not in a position to enter into 4 or 5 collaborations at the same time. It's we're not a private company where we can go to a SPAC and raise hundreds of millions of dollars. So I just want to explain that these SPACs are not for public companies, because they don't want to give you guys in the public any carry on. They don't want you involved in the share distribution. The share distribution goes to the private company and to the shell that's being financed. So there's no room for shareholders in there. You have to be a private company. So that's why we didn't go there. Why we haven't gotten any large grants from the governments before is because we'd already had a process that we were working on. We were not in the initial R&D stages, and so in those cases you usually use a lot of government lab work. They're trying to create work, and we just didn't have the room to do that. Matter of fact, we wanted to stick with the group that we had. Putting together a good group is critical to a junior company. It helps you advance the company along the way. It's the people you have that will build the company for you. So, I'm pretty good at intuitively recognizing opportunities, and I'm pretty good at putting together a good team. So, that's kind of where we're at. But I think this release today was pretty exciting. The stock is up, and we've got other releases coming, but I have to tell you that some of these releases, especially with government work and everything like that, have to go through committees and approvals and everything before the press release can be made. So, hence no press releases. And but we got the okay on it this morning, and so we put it out, and so the shareholders could see that the company was advancing. that the company does have some great opportunities out there. And, I couldn't say more. I mean, this funding is totally different than R&D, and it's basically to build relationships and collaborations with the Canadian and European companies. So, Jim, I don't think there's anything I can add to the conversation today. That I think that this is a turning point for us. And, now people will begin to recognize that we're not blowing hot air. Certainly, I think most companies recognize that we are not blowing hot air when we talk about our process. They have their chief chemists and metallurgists and chief operating officers, in some cases CEOs, in on the calls. So, they can judge for themselves what we've done, what's been published, and see that, hey, this company's on the right track.
Larry, for people new to American Manganese, what does the company do, and where can people find you traded and get more information?
Well, American Manganese is what we call a critical metals company, and we had our start with manganese, and we patented that process for very low grades of manganese in the U.S., and that process is the cornerstone of the recycling process. And, we've got 2 patents on that in the U.S., and we've got a patent in South Korea. We've got a patent pending from Japan, so everything is working well that way. The company, you can read anything. We release everything. It's very transparent. It's all on our site, and you can go to AmericanManganeseInc.com to get that information. We're traded in the U.S., in Canada under the symbol AMY. We're traded in the U.S. under the symbol AMYZF, and in Frankfurt under the symbol 2AM. You can contact the company at any time by emailing LREAUGH@AMYMN.com, or you can phone the company directly at 778-574-4444.
Larry, thank you so much for the update.
You're welcome, Jim.
I've been speaking with Larry Reaugh, CEO and President of American Manganese. I'm Jim Goddard. Our conversation took place on August 13th.
Comments made on Company Showcase are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at HowStreet.com. Company Showcase is a production of How Street Media Incorporated.